Welcome to our continued conversations with Bill Addiss, bond market expert. Bill, welcome back.
Pleasure to be here, as usual.
Now, when I was growing up, one of my favorite movies was Indiana Jones and Raiders of the Lost Ark, which had the Ark of the Covenant. Of course, nowadays I think it should be called the Temple of Doom. Let's talk about Covenant Lite loans, what they are, and how they work.
Yeah, this is becoming a real important consideration in the market these days because banks have always been in the business of making loans. That's the business they're in, exactly. But what we're now seeing is, thanks to structured products, and what we'll get into in a moment, is that banks are willing to make loans to, let's say, companies that are not as strong as they used to be, or banks will make it with less restrictions. And these are referred to as Covenant Lite loans. You don't have all those onerous terms and conditions that need to be met to keep that loan outstanding.
Okay, interestingly enough, that sounds to me like what got us in the mess in 2008. They laxed the lending requirements, people are doing liar loans, and do you have a job? No. Okay, great, here's a $400,000 loan with no job. This lax requirement, it kind of sounds the same, just a nice way of saying it.
It is very reminiscent of what happened in the mortgage market.
Okay, all right.
And for those of us who don't learn history, we're doomed to repeat it. This is one of the fears that we have out there, is that the banks are more and more willing to make those light loans, like light mortgages, because they're not carrying the risk. They're going to pass those risks on to bond investors. So the difference here, though, is I will say the rating agencies have been fairly proactive in this. In terms of getting out there, trying to make people aware this phenomenon is going on and it's deteriorating credit quality in a bigger and bigger portion of the market. This market is $2 trillion in size, these CLOs that we're talking about.
So how, in scope, like how big has it gotten? How much is this Covenant Lite loan market?
Well, this falls under the corporate bond umbrella, and this is where we're seeing, everything's become a bubble. We abuse the word bubble, but we talk about the credit bubble is going on here in the U.S. I mean, the CLO marketplace itself is up by 60% in the last 2 years.
2 years?
Yeah. To now being $2 trillion in size. And in fact, the entire corporate bond market has experienced almost that type of growth, where we're seeing more and more issuers because interest rates are so low, corporations feel very comfortable adding a lot of debt on. Unfortunately, it's not always going to stay this low.
Right.
But we're seeing a credit bubble in the CLO marketplace is just one manifestation of that.
When we saw it in the retail environment, when the appetite for risk for retail investors like you and I, going out there and getting a new home or buying new cars or new devices, trivets, whatever we wanted to get, we were basically going more and more in debt. Now this time the story is different because if I'm hearing you correctly, it's not the retail investor that's assuming these loans, this is businesses. Is this a bigger warning sign? Is this maybe a larger systemic problem?
It does mean the risk is systemic and it's larger, that's exactly right. And your observation is 100% correct. In the mortgage crisis, that was the average consumer, the average homeowner going out and overextending on mortgages. Here we're talking about businesses overextending, but that actually does mean the depth and breadth of the market is even bigger, which makes it even more systemic risk.
Yeah.
And the banks have been very free to issue these Covenant Lite loans because of competitive pressures. They know if they don't issue it, somebody else will. But the fact that they can transfer that risk then onto bond investors means they don't really have to care whether those corporations pay back the loans or not. It's the bondholders' problem, just like we experienced in the mortgage crisis, though, with the difference being key that you mentioned, though.
It's interesting, you had the retail investors were so excited to see the housing market, the value of their home skyrocket from 2004 to 2007, and that was fueled by our appetite for risk. Look at the equity markets right now. You have a huge, 340% move since 2009, and that's fueled by the business's appetite for risk. And that may be coming to a head, another bubble, if you will. On our visual here, you can see the growth going back to 2003. And that's the Covenant Lite loans. You can see a significant spike from, well, let's call it 180 billion to looks to be about $1.1 trillion. That is a huge increase. What is our par outstanding amount there?
We're looking at over 2.4 trillion, and most of that is based on par value, not market value.
Okay.
So, but as a percentage growth, this market is just growing. And the point I think we're bringing into this discussion is understanding the risk component of this. It's risk reward like anything else. These bonds are taking more risk. Hopefully you're getting more reward from it. But we can create different tranches and different structures we're going to talk about. But that declining credit risk is, I think, an important discussion we have to have, because with that huge growth in the corporate bond market we talked about, of which this is one manifestation, the vast majority of those bonds are BBB rated. The single largest category of investment grade bonds are BBB. That's right above the junk category. One notch down and they fall into the world of junk. And this huge proliferation of all of this credit coming into the market, and the fact that it is so low quality. I mean, let's face it, we've had a nice 8-year run.
It's fantastic.
But good times don't last forever.
Right.
And these are going to be the names that are most precarious in the event of a downgrade. They're the most leveraged. They're the ones who are having the problems.
And you've pointed out several other instruments on previous sessions that we've done looking at different aspects of the interest rate markets, the bond markets, as potential warning signs. And you know, this chart is pretty amazing in showing how much it's grown. Let's be clear, everybody, this could still continue on for some time.
Absolutely.
But as you pointed out, all good things come to an end. And it's just about being prepared for when that eventual market decline in this situation happens.
Absolutely, and this is multi-asset. We're not
Right.
just talking just corporate bonds, just muni bonds, just treasury bonds. That credit bubble is pretty much experienced throughout the entire market right now.
Well, bubbles, guys, they present a frightening term to many investors, but for those who are really in the financial markets, it is an opportunity, and it's about being prepared and understanding how to capitalize on a market situation when these events happen. If you'd like to learn more information about these instruments, financial instruments, stocks, options, futures, or much, much more, just click that link down below to get more information.